when that kid is 32, there's another amount of money that's available for the kid to take additional funds out. Now the kid continues to fund until age 65, 66. And then we have what's called a lifetime income benefit rider, which allows the kid to take an additional lifetime income for the rest of their life of some set number forever. So
Holy
not only
crap.
did we pay for, right? So you see where I'm going. But
Right.
what's even better is now you have retirement income. When that child passes away, they also leave money to their beneficiary. So they've also created generational wealth.
Bro.
So that's just to close out that topic. Okay.
That's the whole
Now,
podcast right there. Holy crap. Okay.
You are now listening to the Your First Steps podcast. It's great to talk about $1 million dreams, but where do we start? How do we get there? Listen up as you hear directly from real estate industry leaders on how they reach success in their fields. And most importantly, what were their first steps? Let's get this party started. Here's your host, Eli the Real Estate Guy.
Hey, how's it going, guys? Thank y'all so much for tuning into another episode of the Your First Steps podcast. I am super excited to have our special guest on today, and I'm sure you guys have heard of life insurance policies being an investment vehicle as well. I got to meet this gentleman at a mastermind, and it was amazing. He definitely dropped some great knowledge, and I'm excited for him to really bring you guys some more information. So today we have Dimitri Mills JR. Dimitri, how you doing today, man?
I'm doing fantastic, man. Thank you for having me. I'm happy to be here.
Awesome. Thank you, man. So, well, first, like I was saying, we met at in person at the mastermind that was here in Houston. And what was crazy is the night before, I was actually watching a video of I think it's called Index Universal Life. Is that what it's called? Yeah. So
Yes, it
Index
is.
Universal
IUL.
Life. Yeah. IUL policies, and that's the first time I kind of heard about it. I heard about people saying, what's the term that I say? Infinite banking. I hear people talk
Yes.
about that, but when I saw him, I'm like, man, I got a question about infinite banking and IULs. He's like, oh, I'm gonna drop some knowledge today. I'm like, oh my gosh, perfect. Like this is amazing. So that's how we met. But of course, we met through Otis James as well through the programs and everything that he has. But before we get into all that, for the people that don't know who you are, go ahead and introduce yourself. Let them know who you are and some of the things that you've done.
Sounds good. Hi, my name is Dimitri Mills, as I mentioned. I currently live in California and or out of my suitcase because I've been literally cross country for the last 2.5 years. I miss COVID. I miss Black Lives Matter. I miss the elections because I was just literally traveling in other countries because I live a free life because I'm part of the FIRE movement, Financial Independence, Retire Early, which is one of the other concepts I love to teach people. I'm currently in Colombia, Latin America, doing this broadcast.
Nice.
I've been working with, he mentioned Otis James. I've been working with Otis James for about 1.5 years. And I grew up with Otis, and we've just been on a quest to enrich our communities in not only financial education, but also in just investing in real estate, business development, and a bunch of other things. I just turned 50 years old.
Nice.
Been
Awesome.
semi-retired for about 4 years. And I have a sister, 2 years younger than me, a 7-year-old niece. I live with my mom. My mom lives with me when I'm home. But literally, I've been gone since January in just an overnight bag. So
Awesome.
I'm happy to get home in 2 weeks. But really, that's me. I have a good heart. I live my life forward. I like to make a difference in people everywhere across the world. And that's me, Dimitri Mills.
Awesome. Cool. Thank you so much for sharing that, man. And
Yeah.
so the FIRE movement, and I heard you talk about that before. So explain what that is, what the origins of that is, and how did you become a part of that?
Sure. So it stands for Financial Independence, Retire Early. A lot of my clients come to me and say, Dimitri, what does retirement mean? What does it mean to be wealthy? How much money do I need? And I tell them it's all relative. It depends on the lifestyle you want to live. It depends on what you. So there's a couple things that people don't think about. They only think about making money. What happens when they're unable to make money? What does that do to your retirements, right? What about the raising cost or increasing cost in healthcare? People don't often consider that. They consider that there's an income stream that depends on themselves. Okay.
Gotcha.
So when I say I'm financially independent, it means that I have enough things in process to satisfy my lifestyle and X times income replacement.
Gotcha.
Meaning if I stopped working, well, I'm not working, but if I had to stop working and I had to start consuming, how long would I be able to live without having to knock on my next door neighbor for some money?
Gotcha.
Okay.
Gotcha. I love it. Gotcha. That's
So
awesome. That's awesome. Yeah. Go ahead.
fantastic. And I mean, the other thing too is when you look at financial independence, you also want to look at your lineage and who do you want to hand that down to? I retired my mom last year, so she's part of my FIRE movement. Not
Nice.
only am I retired, now she is as well. My goal is to do my sister in 2 years. So that would
Very
be now
nice.
the whole family settled. Right.
Gotcha. Gotcha.
So
So when you and I know you've heard about it. Where did you hear about this concept from, or was it just something that you already knew, but now there's a name to it, basically? So where did you what inspired that?
well, so I live in Silicon Valley and I always hear these people retiring early, but they often retire early because they had some large payout, they had wealthy parents, or they just, made some really good choice that gave them the financial income to retire. And what's funny, I'm going to answer your question, but what's funny, sometimes I ask my clients, hey, if I gave you $1 million, what would you do with it? And they say, oh, I'll buy this, I'll do this for my mom, I'll do this. And I said, guess what you're going to do tomorrow? They say, what, Dimitri? I said, you're going back to work.
That's real.
and
That is real.
right,
Yeah.
right? And they look at me and they're like, wait. I'm like, exactly. So so when I look at this and this concept, I didn't think it was possible. I didn't think it was possible for me because I had bills, I had debt, I was working 24 hours a day. In my past life was in operations and supply chain. So I was working in multiple countries, dealing with different time zones. So it was very difficult to have what I call my life. My life was dedicated to everyone else. So I couldn't have relationships. I couldn't spend time with my family because I was either on an airplane or on a conference call. Right. So when you look at you're exchanging time for money, what does that do for you as a person and your quality of life?
Right.
So at one point, I just kind of got fed up with that. And I'm highly educated. I have a master's degree from Pepperdine University. I'm well spoken, well dressed. And I just couldn't understand why I wasn't getting ahead. So then that's when I started looking at what other people were doing to achieve financial freedom and create additional income streams or passive income.
Gotcha. Gotcha.
And that's when I started my quest. Go ahead.
Gotcha. And yeah. And so, as far as you starting first kind of going back to supply chain, I guess we'll start kind of all the way back, just kind of going from the beginning and how things led up to that point. And so let's start back off from when you were a kid, growing up in the Mills, household. What was that like? And was there always an influence of insurance investment then? Or was it you kind of lived, a regular life and you're kind of used to seeing, 9 to 5 paycheck to paycheck life, or explain what that life looked like for you as a
Uh,
kid.
sure. So we had a normal nuclear family. It was my mom, my sister, and my dad. We grew up in Chicago, Illinois, in the South Side, 38th and Rhodes, Ida B. Wells. So it was a housing project. It was so bad we had a police department on the complex.
Oh, wow.
So it was pretty bad. Me and my sister lived in a drawer, like the dresser drawer. I slept on the top drawer and she slept on the bottom drawer. So
Really?
we grew up very, very poor.
Gotcha.
Now my parents worked multiple jobs, so I grew up seeing them not very present in the house because they were exchanging the time with their kids for work to put food on the table. So I remember that very, very well. So as we grew up, things kind of got better, and then we migrated from living in the projects, we moved to the suburbs. When we moved to the suburbs, obviously things got a little more easier just because we didn't have some of the other stresses that our surroundings or, some of those other influences.
Right.
Now, as far as working and education, that was always really, really high in our household. Now, my parents took out insurance policies on both of us when we were kids, but they took it out in a way so that it would provide money for college when we turned 21, 22. So both of our parents did do that. But what's funny about that is when I talk to a lot of my clients, most of the other people have not done that for their kids. So I'm really surprised that my parents did compared to my peers.
Gotcha. So quick question. Both of your
Yep.
parents, are they, so your lineage? Was everybody born in America for as far back as possible, from what you can remember, basically?
Yep, I did
Okay,
my 23andMe.
gotcha.
They're African Creole, so from like Louisiana. My mom could
Okay,
cook some gumbo.
gotcha. Okay, there you go. So when it came to the insurance policies that they got, what made them get those policies, and what gave them that foresight of like, oh, this is something that we should probably look into because it's important for us to have these funds for our kids later.
Sure. So I'm assuming that they got the policies because they were poor, but they wanted to provide money towards college for us. So the main reason was to give us some type of future greater than what their future was.
So, but how did they know that that was even a possibility?
That I don't
Okay,
know, and I'll have to
gotcha.
ask my mom that question
Yeah.
and get back to you.
Yeah, because
That I
that's
can't answer.
something that I think is very interesting because there's a lot of folks that I would talk to that didn't end up going to college, and I would ask them why didn't they go, and their main reasons was I don't want student loans that's gonna keep me bogged down for the rest of my life, and also I didn't have the money, so I didn't go. But I know growing up we didn't have money either, and because of that, I was able to get grants to go to well, at least most of my college for free, and I only had to pay for like the last couple semesters. But it's like all that was free because there was no money, and it just kind of made me wonder, okay, well, where is a disconnect in communication? But I had to realize I was blessed that my sister, who was 6 years older than I am, she already went through the process of college. So she was like, hey, fill out your FAFSA, make sure you do this. Here's the deadlines. Here's this and that. And so definitely, whatever you talk to your parents about the life policies that they got for college, like I would love to get like some insight and maybe having all you guys on and talking about like where did that even come from, because that's not
Sure,
something that's just general knowledge that people would know. But you say
sure.
education was very important. Why was education important to you all?
Because we knew education gave us opportunity.
I love it.
Right. And so, but let me tell you, let me expand on that because a lot of our family also didn't have a lot of money. We knew we didn't have a safety net. We knew we didn't have anyone that we could fall back on. So our lineage had to come from us,
Gotcha.
if that
Gotcha.
makes sense.
Yeah, absolutely. So, moving forward, so as you became, say, like a teenager, did you have like jobs at like the grocery store or some things that you worked on as you were a teen, or were you a hustler? Like, how was that?
Great question. So I literally had no less than two jobs almost all of my life.
Wow.
I mean, I used to be a security guard. When I was done being a security guard, I would sleep in the parking lot of my next job where I was a material handler. And then I left the material handler job and then I went to school.
Wow.
So I literally, those are my days. And that was most of that was on the bus when I didn't have a car. So this is at this point now I'm living in California, but I can tell you how that transition happened as well when you're ready.
Yeah, go for it. Go for
I
it.
guess. Okay. So one day my mom literally showed my sister and I a picture of a beach and a palm tree. And she said, baby, how do you like this? I said, Mom, it looks great, but where is it? She said, San Jose, California. And I said, that sounds far. So but pretty much we packed up and left. Remember, we were living in Chicago, and just back 20 years ago, Chicago was a very different place. So we were looking for opportunity, looking for change. And I want you to remember, I say change because change comes from changing your surroundings and changing the influences that you have in your life. So please make note of that. Okay. So now we pack up and we move to California. But guess what? There were no beaches and no palm trees in San Jose. So I said, hey, Mom, you bamboozled me. You tricked me. She said, yes. She said, I did, baby, but I wanted to give you more opportunity. And I think this place will give us opportunity.
Gotcha.
So from there, it's really important. So then I started meeting people from all races, all cultures. It started my first time leaving the country. I've been to 86 countries now.
Oh, wow.
And
Very nice.
I've been a lot of places. And half of those places I've been with families that I've met from California of different races, cultures. But they bring me home, so I get a whole different experience.
Gotcha.
And why that's important for my development and for the development of the people as well is you have to look through the lenses of other people very often and not just through your eyes.
That's very powerful. And the reason why I say that is because so I'm Haitian. All my family is from Haiti, and something that I realized growing up, and I kind of took this for granted, but I appreciate it a lot more as I got older. We used to go to Haiti at least like once or twice a year for when I was 1 to about 10 or so, and then a gap, and then I went later on. But by just going there and just seeing a different way of life, and understanding why things are the way that it is, why certain structures are the way that it is, where the food comes from, and just kind of seeing something different, it made me appreciate other aspects of life. And it opened my mind to other possibilities and understanding the reason why my parents came to America was to make something happen and make something out of themselves. And when having children, it's the pressure of, hey, you're not here to mess around. You're here to get things going, because whenever they came with the intensity of you got to go to school, you got to do this, you got to do that, it's not from a standpoint of starting off in America, moving forward. It's I know how bad it can really get, so this is why I'm pushing you forward. So it's great that you got the exposure of different cultures, and just being able to go to so many different countries and doing that. So kind of staying on that for a little bit. What was your first experience with someone's different culture that surprised you? You're like, oh, I had no idea this was even a thing.
Well, the first thing that really surprised me, and it sounds funny, is that I thought Chinese, Vietnamese, Japanese was just one type of ease. So I didn't know that. What I mean by that is Chicago was still very black and white back then, 20 some years ago. Yeah. When I came to California and you see this melting pot of so many cultures, I just really thought there's just a new culture. Now there's black, white, and something else.
Right.
So that was I became super curious, and I just wanted to learn, and I wanted to be friends with everyone, and I became friends with everyone. I literally have friends I speak multiple languages now. I can cook different foods. So I've become the melting pot in myself.
Gotcha.
But that's how I look at the world now as well.
Gotcha.
So I'm total equal opportunities in my life and the way I feel about people and things.
So was there anything that surprised you in general the first time you were exposed to something? Like, for example, I know when it comes, just with different customs or different sayings or something that you were introduced to, that you're like, oh, I didn't even know this was a thing. Like, is there something that you can maybe pinpoint that you can think of?
Sure. The quickest thing is just taking your shoes off at the front door and respecting the household.
Gotcha.
Number one. And number two, the respect that a lot of other cultures have for their elders and how they take care of their elders throughout the lifetime of their elders versus putting their elders, in secondary care and secondary homes.
Gotcha.
So that it's very eye-opening.
Gotcha.
Right?
Gotcha. I love it. That's good. So now you're, you went from teen to adulthood. You had, always at least 2 jobs as you're, moving forward in your life. And so now working towards college, what was, so is that during college time where you did the security job and the other aspects?
So it was yes. So I took 2 years off and I went to Grambling State University in Louisiana with the money that my parents had put away for college. So I used that money in a combination of some grants and loans, but that money ended up running out. So when it ran out, I came back to California and I started working where I was telling you I was working multiple jobs. And then I was spending some money to put my sister through college as well. So I just felt that my father did not come with us to California, by the way. It was just my mom, my sister, and myself.
Gotcha.
So we lost that support. So I became the man of the house.
Right.
So by becoming the man of the house, I decided to keep working and help put my sister through college so that she could be successful until she got on her feet. She went to DePaul University in Chicago. Right. So she went to a very prestigious school as well. So now fast forward, now I'm still in school at night school. Then I finally graduate. Then I graduated from school in California. Then I finished that graduation. Then I went to get my MBA in Pepperdine, and I paid for all of this out of my own pocket. So that was, and why that's important is a lot of people get the gift of college, and that's something I can show people how to get now. Because I don't believe that you should be paying for college out of your pocket every year. You should use your money, let your money grow, and use a portion of your proceeds to pay for college. It's just a different approach. And I can talk about that. I actually would like to talk about that when the time is right with you.
Got it. So this type of policy, well, first the ones that your parents got for you, Is it the same type of policy that you teach people how to use, or is it a different kind of policy?
It was pretty similar.
Okay.
What they got was just a simple life insurance policy that had cash value and cash accumulation, and they put just enough into it to provide money for college. But when they took the money out, they consumed the entire policy, so nothing was left.
Gotcha.
I designed my policy so you're covered for your entire life,
Gotcha.
and that's my goal.
Okay, so yeah, let's talk about it. So, people that want to get into college and they're thinking that it's impossible, they don't have the money, they don't want to get into student loan debt, and how student loans are basically, a chokehold on millennials and a lot of people from going to the next step in life. They want to own homes, they want to have better cars, live a better life, but it's that dark cloud of student loans that's following them everywhere they go. So how would you help them in that process of saying, hey, they want to go to college, but how do you help them get away from the cloud?
Fantastic. So there are kind of two programs that are specific for colleges. One is a 529 plan. Okay. A 529 plan is where the parents put money aside and that money grows. That money grows with the stock market. And over time, that whatever your contributions plus the money you're putting into the process creates some value. And at that time, you can take that value and use that towards college. Okay. So that's called a 529 plan. But there are some cons with that because it's also tied to the stock market, which can be a negative. The other thing is it goes against ordinary income, meaning if your parents make 100,000 and you have 100,000 in the 529 plan, now you make 200,000 on paper. So it may make it more difficult for the child to get grants and the free money when there's other people that are more deserving.
Gotcha.
Okay. And the third would be what happens if your kid gets a scholarship or doesn't want to go to college, but now you have $100,000 that's slotted specifically for college. That money has to be used for college when it's in the 529 plan. Oh. So that becomes a problem. Yes, you can still use it, but you're just heavily taxed because it wasn't used for college funding.
Gotcha.
Now, what you can do is you can use that money for other kids. It doesn't have to be your kid. You can go to the neighbor and say, hey, I have this $100,000. And maybe you can figure out how to work it out, but everything's tied to your name. So that's the way a 529 plan.
Gotcha.
What I do instead is I will get a policy for the kid. And let's just say it's a newborn. I have the parents tell me how much they believe they want to have for the college student. Let's just say it's $100,000. I back into that, determining how much they need to put per month, per year, twice a year, until their child turns, let's just say 22 years old. And their contribution plus cash accumulation inside of an index IUL will create some number. And the goal is to get it to be that number that they want. Okay.
Gotcha.
Now I did this exact thing for my sister. But let me just tell you how it works. So let's say the policy was $250,000 in face value. So that means that if something happened to the child, the beneficiaries would inherit $250,000. Okay. That's number one. Number two, the policies I designed have what's called living benefits, which is very, very important. What that means is if the child has a qualifying illness or injury in life, they get access to money. They don't have to go GoFundMe pages. They don't have to ask for help. They're able to use this money to, take care of themselves. Now, the third thing is now you're putting this money aside for their child. So now let's say the kid's 22. You have $100,000 in this policy. You withdraw it, and you use that money to pay towards your college tuition.
Gotcha.
Okay.
Gotcha.
Okay. Now, there's a couple other things. Let's say the kid decides not to go to college. There's still $100,000. You do whatever you want with it. Buy a car, buy a house, start a business.
So, quick
now
question.
You have options. Yes.
So, with this life insurance policy, and say if it accumulates up and they have a cash value of 100K that they could pull out, which I'm assuming you said up to that 22 age, basically. So, if that policy is still active, would it still count against them whenever they're applying for like FAFSA and showing like this is no? Okay.
It does not.
Okay, awesome.
Great question. It does not, because it does not go against ordinary income.
Gotcha. Okay.
And I mean, if we want to talk about that, so IRS code 7702 states that any dollar earned inside of an insurance policy grows tax free. And we achieve that by paying the taxes now. So there are no additional tax consequences if it's funded correctly as well. Okay.
Gotcha. Okay.
So, so the money comes out in the form of a policy loan in the name of the child. Um, so kind of the way the full process would be, let's say the parents take out a loan for their child at age 19. Okay. Now you take out the regular loan, but remember, college loans don't need to be paid back until 1 year after you graduate. You see where I'm going with this?
Right, right.
So now you take the policy loan from your insurance policy, pay back the loan, booyah.
Gotcha.
So
Gotcha. Okay.
everybody wins. As opposed to a parent just paying every year on tuition. There's no cash accumulation in that. You're exchanging time for an asset. In this case, you're putting your asset to work and letting the asset grow to buy a bigger asset, and that's the education. And that education can never be taken.
Gotcha. Okay. Okay. So I'm kind of like some thoughts are kind of bubbling in my mind right now. So I'm trying to think about this. So loans are not considered income. So you can take the loan and pay for items, but you just pay it back. But there's something that I read in one of the books that you recommended at the mastermind. They're basically saying, let me get to the bottom of this here. Once you get a loan to pay for something, is there a way for say if you're not able to pay it back or something like that, right? I think there was something along the lines of you just take the funds that were available, but you still have the policy that continues. Like, explain that, because that, to me, that was a gray area from what I know of life insurance. If you stop paying, then you don't have a policy anymore for those. So,
Sure.
so explain that process. Sure. Yeah.
I'll explain that to you. Well, so let me close on one topic on the college funding first. So when that child takes the money out at 23, let's say the parents were putting that money up until that kid is 22. Now the parents simply turn the policy over to the child and let the child take over funding the policy from there. Now, when that kid is 32, there's another amount of money that's available for the kid to take additional funds out. Now the kid continues to fund until age 65, 66. And then we have what's called a lifetime income benefit rider, which allows the kid to take an additional lifetime income for the rest of their life of some set number forever. So not only did we pay for it, right? So you see where I'm going?
Right.
What's even better is now you have retirement income. When that child passes away, they also leave money to their beneficiary. So they've also created generational wealth. Bro. So that's just to close out that topic. Okay.
That's the whole podcast right there. Holy crap. Okay. Awesome. I love it. I absolutely love it, man. So, okay. Wow. Okay.
So policy loans and the way it works.
Yeah, go ahead.
Okay. So policy loans and just the way that works, right? So let's say you have 250,000 in face value and you have 50,000 of that is in cash accumulation. You take out 50,000, you put it in your pocket. How much do you have left in the policy? Well, let me give a better example. If you have 100,000, you take out 20, you have 20 in your pocket. How much do you think is left in the policy?
Right, so you should have 80. If it was 100, you took out 20, you got 80.
You have 80. That is correct in theory. In actuality, since it's a loan to yourself, the insurance company will say, okay, well, you're going to pay back that loan of 20,000. So your cash accumulation continues to grow on the 100,000, not on just the 80,000.
Okay, why?
So it's right. So because it's a loan and you're lending it to yourself, they assume that you're going to pay it back.
Right.
So because you're going to pay it back, they continue to pay on the entire cash accumulation that you have.
Gotcha.
But when you take something out, what happens on the other side of the equation is if you have that 250,000 face value, it drops by 20,000. So now you have 230 on that side, while you have 20,000 of utilization in your pocket.
Got it.
So that's how the teeter-totter works.
Okay, that's the disconnect that I had. I'm like, well, this money has to go somewhere from there. So from there, I've also heard of the situation of say if you front load your policy and you're flipping houses and you're making, chunks of cash. So in a year, say you make like 400 or 500,000 or so from flipping, and you have this policy, and you're putting a large sum, say, 100 or 200,000 into the policy. How can you then just not pay after that? Because there's something about if you front load a policy that you could just not have a premium that you're paying every month. So explain that, or if that's even a thing.
It is a thing.
Okay.
One more thing. Let me close out the other topic too.
Yeah.
So when you took that 20,000, when you're earning interest, guess who gets the interest?
Ourselves.
So like when you take money,
Yeah.
yourself, exactly. So what I mean by that is, let's just say it's 3%, and you've taken that 20,000 and kept it for 2 years. 3% of 20,000, let's just say for 2 years it's $1,000. When you put that 20,100 back into your policy, your face value jumps back up to 251,000 now. So you make money. You're earning money on your own interest, and that's a win. So I just want to make that point.
Absolutely.
Okay.
Love it.
Okay. Now to answer your question. So there are 4 ways to pay a policy. You could do monthly, quarterly, twice a year, one lump sum, or you can also do what's called a premium deposit, where you put money down into the policy and they release it to your policy as each year comes. Okay. Now, the reason why we do that is there's a thing called the MEC, Modified Endowment Contract. That is the maximum amount of money you can put into a policy at any given annual year. Okay. Now, this is very important because remember when I said IRS Code 7702 states that your money earned grows without taxes. So people may have seen this as a vehicle to reduce their tax exposure, right? So the government said, no, we want to make sure you operate within specific guidelines. So they've created this ceiling. And what that does is that says that you can only put a certain amount into this bucket and nothing more. If you put anything more, that becomes taxable, and then that then it causes all sorts of problems.
Gotcha.
So to answer your question, when I'm working with real estate agents or anyone that are high income earners, we design policies based on what they need from a coverage perspective. And generally policies are designed one or two ways: what you need or what you can afford. Okay. And what you can afford often comes into play as what you need from an income replacement. If you are unable to work, how much money do you need per month, per year to continue your quality of life?
Gotcha.
Okay.
Right.
And that's super important for us as entrepreneurs, because now we're entrepreneurs. We've given up that security that the W-2 job used to offer us. So we have to put that back into our lives.
Right.
So when I do the policy design for those clients, I have the ceiling as high as possible. So when they put the money into the policy, it just hits as high as possible. If that makes sense.
So what is that maximum amount that I guess the law says?
It depends on policy design.
Okay.
Meaning, so remember that $250,000 policy I was talking about? So obviously $250 would probably be the maximum amount of money we could ever put in, $250,000, because that would fill up the policy. But there are 2 types of policies. There's also increasing and level. If it's an increasing policy over time, that policy is going to increase and increase and increase and increase as you make premium payments.
Gotcha.
So that naturally will allow us to put more money into that policy.
Interesting. Okay. But it would be increased amount, but there's still a cap to how much you can put in there.
There's still a cap. Absolutely.
Okay.
Absolutely.
And it all depends on how it's designed. So for one person, it could be 200,000, but another person could it be like 10 million or something based on how it's structured?
Correct.
Okay. Gotcha.
That is correct. So like my MEC is like around $150,000 a year is the maximum I could put in. And I also design policies so I have a min, a mid, and a max, because I'd like to give clients options so that they never feel like, oh, Dimitri, I'm locked into this. No, let's lock into life, because life evolves and we don't know how things are going to be next year and the years, to come. So I always want to give my clients a range, but we sit down together and determine where we're going to target.
Gotcha.
Right. So when I set that target, if it's an agent and that agent knows that he's going to have a bunch of extra residual income over the years to come, I can show him what that looks like if he were to put that money into this policy and use that to pay future premiums or to stop making premiums.
Gotcha.
You know?
Okay. And so within one policy, you'll have it set to where there is a max, but then there's a minimum contribution that they have to put. And then if, they're not trying to do the max, but there's that in between of, well, you can at least do this. But I guess it'll be set up as like an auto draft type situation, or is it a thing of
Yep.
you just pay whatever?
Yep. So I generally set everything up on auto drafts with the ability to put more in at the client's discretion. Okay. Now,
Gotcha.
because there's that thing, we want flexibility and options in our life, right? So, and on top of that, I also set it up so that they can make other changes as needed as they grow, as things change in their lives, right? So one thing that's important to note is that when the client is putting the money into the policy that way, it's still growing. The average rate of return on some policies right now, let's say it's 5-6%. The best rate of return in a bank right now has been like 0.65.
Right. Exactly.
Right.
Gotcha.
So maybe it's a good time to talk about the different insurance types.
Yeah, go for it.
So your client's so there are 3 types. There are term policies. Term policies covers a client for a specific term. And let's say that period of time is 30 years. On the 31st year, they are 31 years older, obviously. So the cost of insurance has increased, meaning the cost to continue coverage will also increase.
Right.
Okay. But term policies are inexpensive because of that specific term. Certain companies have term policies that also include living benefits, which again gives them the ability to access funds in the event of qualifying illnesses or injuries. And that's very important. But there is no cash accumulation inside of a term policy.
Gotcha.
So I write quite a few terms, but I generally write terms to cover the client so the client has something, because something is better than nothing. And what's our most important asset?
Ourselves.
That's ourselves.
Absolutely.
Right. And we often forget that. So the second, there is permanent insurance. And permanent insurance comes in 2 forms. That will be whole life and IULs. Now, whole life, most whole life policies determine your whole life to be up to age 99, but you can design them or pay them off earlier. But if it's supposed to be age 99, they expect the payment until age 99. So I kind of have a problem with that, because I want my clients to pay things off as quickly as possible and then live their life without additional payments.
Right.
Okay. Some whole life policies also have inflexibility with their premium payments, meaning if you start paying $300, you can always pay more, but you don't often have the luxury of paying less.
Right.
So some of the premiums are less flexible. Whole life policies have guarantees built in, which is one reason why that the cash accumulation is good over time, because you're guaranteed to make some rate of return. And that's good. But when you're paying for a guarantee, there's a cost to get that guarantee. Sometimes that cost cuts into your cash accumulation.
Yeah.
But again,
I guess give an example of that. Like, is it like additional fees that go into that, or is just a lower rate of return, basically?
So it's a lower rate of return. It's a guaranteed rate of return. But because it's a guaranteed rate of return, that comes at a cost, because we're guaranteeing that you get that rate.
Gotcha.
If that makes sense.
Right.
So then now the IUL, which is Indexed Universal Life, those have flexible premiums, meaning, remember I just talked about you can have a min, a max, somewhere in between. Depending on the company, some companies have guarantees for up to 40 years, meaning if you're guaranteed your policy is guaranteed not to lapse as long as you make the minimum payment. So you still have the same guarantee. But when I design my policies, my goal is to design it so the client is only paying for 10 years or less, or up to age 65, but no further. That's always going to be my goal. So I'm always doing the front loading, or I'm showing clients how to multiply their money faster.
So why do you? Is that the reason why? Is it because it multiplies faster if it's up to 65 rather than 99?
No. So if you just look at paying, let's just assume you're 30 years old. 30 to 65 is 35 years. Right? And let's say you're paying $1,000 a year. Now you're only paying it for 35 years.
Right.
as opposed to paying until age 99, which is a larger number.
Right. Gotcha. And so because
Okay,
you stopped at 65, well, I guess go ahead and explain the rest of it. Yeah.
no, so what I'll do is I'll compress that. So I have the client pay, sorry, I'm just emotional,
Yeah.
within the first 15 or 20 years or up to pay age 65. But I designed the policy so that at age 66, additional premiums become optional, not mandatory. So
Okay.
basically the policy is paid off. It's paid in full because it's your contribution, your premiums, plus cash accumulation
Okay.
over time
Gotcha.
satisfies the policy requirements.
And so at that point, you have this lump sum, and you can choose to take the value of it over time, and then the remainder you can just have that be sent off to your beneficiaries.
Yep, you kind of have three options. Well, four options. One, you just do nothing. You stop making your payments. You don't take any cash. You leave all of that cash accumulation or your face value to your beneficiary. That would be option number one. Number two would be you take some and do whatever you need. Maybe you need to buy a house, pay off some bills. So now you've reduced your face value and your policy stays whole for your rest of your life. Three, I guess you could take all of it and just consume the policy. Now the policy's done. That's an option. But my goal is to keep you covered. But things happen. Number four would be to create that lifetime income benefit. So now you're paying yourself an income stream for the rest of your life. But guess what? You determine the age. It doesn't have to be age 65. It doesn't have to be age 70. It could be age 43. It depends on how you fund it. But guess what? You still get Social Security most likely. You still get the benefits or income from all the other income streams you have. This just becomes an additional income stream in your life.
Okay.
See the difference?
Yes. Okay. So now I'm thinking about, all right, so you have yourself this policy, and you set it up to where the policy is set up to say, like you said, 65. But if you are able to pay off the total amount by the time you're 40, then you can set it up to where you have the additional stream from 40 to 65. And it
No,
just,
from 40 to age 120. It's from 40 to the rest of your life. Remember, it's a lifetime income benefit.
gotcha.
You get that
Okay.
forever.
Okay.
Forever. So now it becomes a math problem, right? So let's say if you start taking income stream at age 42 of $2,000 a year, just for example, and if you live through age 90, that's the average life expectancy. So 90 minus 40 is what, 50 years. So 50 times 2,000, that's how much you would take over that time period.
Gotcha. Okay.
Okay,
Gotcha.
but
Okay. I'm good. I get what's going on now. Okay.
Okay. But let's say you don't take it at age 42, you wait to age 60. So now that money's sitting in there like that gumbo and marinating and tasting better.
Right.
So now you start taking it at age 60. So now it's not 2,000 anymore. Now let's say it's 10,000. But now it's 10,000 over a shorter period of time. But now is that 10,000 over, that's 30 years greater than that 10,000 over those 50 years.
So is that something
It's just
that
a
you
math
set
problem.
up? Is this something that you set up at the beginning of the policy, or do you just say, all right, now I want to start
Great question.
deducting at the end?
Great question. So we model it at policy design. We just show the client what they could be. We do a series of what if scenarios.
Yeah.
Okay. And then once we agree on what the client wants, we set that. But when that client gets to that particular point in his life, he still has an option. Because remember, if we set it up so the policy's paid off by age 40 or 50, he still can keep making payments if he wants. And all that does is keep funding the cash accumulation and the growth inside the policy.
Gotcha.
But he has the option to stop or continue or do other things.
Gotcha. And then from there, would it be, so as they're taking funds out, it would just be balancing out. So at that point, it's not a loan. You're not getting.
It's still considered a policy loan.
Okay, but so it'll be deducted from the face value. But if your goal was to have a certain amount, then you could balance out how much you're going to be taking versus what the face value would be, and say you balance it out to where it's okay. Well, though the face value is 300,000, I'm going to be taking X amount per month, and assuming I die at 100, then I know what my face value will be, and the remainder will go to my family as a beneficiary.
Sure. What they really do is they base it on your life expectancy of 120. So when you start asking for that lifetime income stream, it's over the course of if you live through 120.
Gotcha.
Because they want to make sure the client doesn't run out of money. Now, you can take a policy loan or you can take a full withdrawal, but that just behaves a little bit differently when you just take cash out. Generally, I prefer the loan option because you can still put money in and out. It gives you more control over what you're doing, in my opinion.
Gotcha.
But,
Cool. And so, from my understanding as well, as far as these different policies, you're able to have a floor of. So basically, you won't lose money.
Indexing.
Yeah, with
Yes.
indexing. Yeah. So explain that process and what does that really mean?
All right. So there are three ways you earn money. There's level, which we talked about, meaning let's just say I'm always going to give you a 3% return. With a 3% return over the course of your life, how much cash would that grow? How much would you accumulate? Okay. But I want to talk about something before I talk about this.
Okay.
I want to talk about inflation, and I want to talk about taxes.
Okay.
Inflation is approaching 7%. Okay. So that means everything around you is getting 7% more expensive. Right? Now we all pay taxes. But again, do you think taxes are going to get higher or lower, in the future?
Probably higher, I'm assuming.
So most people agree with you because when we look at history, we always see a spike in taxes based on what's going on in the previous years, whether it was the market crash, whether it was war. Right now, we're kind of going through war, but we just got out of a pandemic.
Right.
So the reason why I'm talking about that is that when you're putting money into a permanent policy, you're paying your taxes now. So it's nice to pay taxes while taxes are low because at some future day, taxes may go higher, but we don't know, right? So again, if we have a 7% inflation and you're guaranteed a 3% return on your policy, you're making money, you're not losing, but because everything's getting more expensive around you, do you see where I'm going? So it still may be a problem, but that's the way level works. The variable market is stock market, cryptocurrency. You can make a lot of money, but you can also lose a lot of money.
Right.
Now, I talk about this a lot with my clients. It's like, if you're over the age of 30, how much time do you have to recover from a loss? Right? I have clients constantly coming to me, Dimitri, what do you think about the stock? Or what do you think about this crypto? And I just try to pull them back and say, hey, let's put X percent of your net income in a variable market, but let's put the rest in an indexing strategy or something like that. So let me move to indexing.
Right.
The way indexing works is you have a 0% floor or a 1% floor, depending on which company you're working with. And then you have, let's just say, a 9.5% ceiling to 11%. Again, depends on which company you're working with, but there's a ceiling and there's a floor, meaning you're always going to make money earn money crediting between this range. Now, people say, Dimitri, but I'm missing out on the upside of money in the stock market. And I say that is true. You absolutely are. But would you much rather have money or lose money?
Exactly.
Because people are always talking about they're making money, but you don't hear them talking.
They get quiet on the other side.
they get quiet.
Right.
And I think it was Warren Buffett who had a contest against someone. He put all his money in an index strategy versus the market, and I believe he made more money in a year's period of time. Wow. It's just because, and I have charts that show this. Why that is the way an index strategy works is if you have $100, and in the regular market, if you have a 50% loss, now you have 50. Would you agree?
Right.
Okay. Now, if you made 50, how much do you have?
Yeah, 150.
Or made a 50%. I'm sorry. If you have a 50% increase, what do you have?
Yeah, 150.
So most people would either think that, but the way the math actually works is 50% loss brings you to 50. A 50% gain brings you to 75. So that's the way the variable market works. So now you're in a hole. You're in a deficit by $25.
Gotcha.
In an index market, you have that 100. When the market drops below zero, you stay level. So you're already winning compared to the way the variable market would have performed. So now when you get that 50% increase, you're increasing from 100.
Gotcha.
Not from. So that's why I prefer indexing. But go ahead.
So with that question, all right. So is this over the course of a year or a quarter? adjustment? How does that work?
The crediting is annual. It's
Okay.
generally annual. So there's a period in time that you start, and there's a period of time that you end. And if the market performed higher or lower than the average of that period of time, the insurance policy credits you, and that credit, there's other calculations, and that helps to determine how much you get credited. So how much how much more money you get on your cash accumulation inside your policy.
Gotcha. Okay, that's yeah, that was great information. So if somebody wants to, well, actually, let me back up with it. I know you touched on this a little bit to where you got introduced to life insurance from your parents getting the policy, and then as you move out to California, you're finding other wealthy people also using these strategies. So, at what point did you say, "All right, this is what I'm gonna start doing," as far as getting my license and also like teaching people about insurance? Like, what brought that about?
Sure. So when I got the money at around age 21, 22, all I saw was the money. I didn't care about the vehicle that created that money. I didn't really, yes, my parents did. I'm just like, I was like, thank you, parents, for doing this for me. Okay. But I didn't really understand what that vehicle meant, and nor did I really care because I was just young and I had student debt. And I needed to pay this debt. Right. So now fast forward to age 44 or so. Now I'm working in the corporate world. I'm stressed. I'm working all those hours. And I'm like, gosh, there's got to be a better life for me. What could it be? So a friend of mine who I grew up with recommended that I go to John Maxwell. So I went to John Maxwell and I became a life coach. I didn't know who he was. I had never heard of him before, but I wanted to start working on my PH me, meaning becoming the best version of myself.
There you go.
Okay.
I like that.
So I started with John Maxwell. I paid for my sister to go. My sister became certified. My mom went. I just said, hey, let's just go do this.
Right.
Right. So then I came back and then I went to Tony Robbins. And that's where I called Otis and said, Otis, hey, let's take a trip and let's go see Tony Robbins. So then Otis and I went and we did Tony Robbins, signed up for everything. And again, we continued to work on who we were. Right. So then when Otis and I came back to California, we started thinking about this. We're like, we're highly educated. We have a lot of power. We have a lot of influence, but we are ourselves hitting ceilings. What are the problems? So both Otis and I looked at our circles and we decided to separate ourselves from certain people so that we can focus on becoming the best versions of ourselves. And we just did that. And all those people gravitated back to us because we were leading by example. Remember when I started this conversation, I said, when I moved from from Chicago to California, remember the word change?
Yes.
This is why. This is the changing moment. But I had to change myself and I had to change my surroundings to become who I
love that.
Because otherwise,
I love it.
you're held back, right? We're
Right.
held back by things we don't know or things we think are comfort or friends that think they're subject matter experts, but they're not.
Right.
So invest in yourself. And that's why I'm happy that you read some of those books I shared with you.
Right.
Because now you're not just listening to Dimitri. You have a second source of the truth.
There you go.
Right.
Yeah, absolutely. Right. And so there's something that you said that's very interesting. And I know there's a lot of people that also need this advice because you just you spoke about it. So you change your surroundings. But what do you say to someone that is in a particular spot? They're born and raised in this one spot. All their friends are not on the same page of where they want to go, but this is what they know. So what
Sure.
would you say to that person, and how would you say separate yourself when their surroundings are all around them?
Sure. So I say the first thing is you need to identify your limiting beliefs so you can understand, one, where you want to be, and two, what's preventing you from going there. So Otis and I say this all the time. You can't hit what you can't see. So you got to put things on paper so you can figure out your path. Number 2 and 3, you need to get accountability partners. You can't do it alone. Now, you said if they're surrounded by people who don't know, where do you find people? So this is where they have to reach out on their own, out of their comfort zone, to find someone that is doing what they think they want to be doing.
Gotcha.
And believe it or not, people are willing to help, but you just got to ask them because they don't know what is in your mind or in your heart.
Right.
Okay?
Absolutely.
Number 4 and 5 is our friends and our families are also often uninformed. Our schools are often uninformed to these things. So those are the people closest to us, but they're not the right people to go to.
Gotcha. Makes
And
sense.
and that's one of my goals as well, is to educate our parents so that their kids understand financial and education and can pass that on.
Gotcha. Love it. Awesome. So, if somebody wants to get a consultation or really get down deep and explain their specific situation, what's the best way for somebody to get in contact with you?
Sure. So I can give you my email. I have a 10K card. I have a lot of ways to be reached.
So, what is
My
your email? Yeah.
Sure, it's Dimitri, and that's Dimitri at Napier Consulting Group, and Napier is Napier.
All right. So what I'm going to have to do is put that at the bottom of the screen, so you guys will see
Okay.
that at the bottom there, and that way they'll have a visual of it. And do you have so your 10K card? What's the website for that? Or is it like a something that you explain
So
10K,
I
because
can keep.
this is new to me.
Sure. So 10K is a digital business card that forms a QR code that you can just scan, and all of my contact information will be imported into the client's phone. So
Gotcha.
that way, it just makes it importing a lot easier. So I
Gotcha.
can share my QR code as well, and you can put that on the screen
Sure.
when you
Okay.
replay this, and that will make it easy for people to get in touch with me.
Gotcha. So how would, man, I know I sound old if I don't know how this works. So if it's on their phone, how would they
hmm
be able to scan it if it's an image that's on their phone? Because I know you can scan something if you
Oh,
can look at it, but is there a
oh,
way
sure.
to do that separately?
Sure. So I'll include the link. So there'll be a
Okay,
link plus an image. So
perfect.
they'll be able to do both.
Gotcha.
Correct.
Okay, awesome. All right,
Um,
so that was that. So this part of the podcast, what we do is we talk about the books that you would recommend for someone who wants to one learn more about insurance policies and just overall how this can really change their life and their perspective on life and their possibilities on what
mhm.
their trajectory would be and what their family trajectory would be. So, what are some books that you would recommend that people read?
Sure. Now, the first book I'm going to recommend is called Money, Wealth, Life Insurance: How the Wealthy Use Life Insurance as a Tax-Free Personal Bank to Supercharge Their Savings. Now, this is by Jake Thompson. This book is only $8, guys. It's $8, and it's about 90 pages. If you started with that book, that's going to give you more content than half of the other books that I'm going to recommend. But I'll just recommend one more. That's called Tax-Free Retirement by Patrick Kelly, or The Retirement Miracle by Patrick Kelly. If you read any of these, I guess another one would be The Power of Zero by David McKnight. Zero means what are you paying, and you're not having any interest. You're having a complete return on your money,
Gotcha.
because you're not paying taxes, so you
Gotcha.
reduce your tax exposure, right?
Gotcha.
So yeah.
Awesome. So now we're gonna do the lightning round. All right. So where I'm
Okay.
gonna ask you 3 questions, and you just answer them to the best of your ability. All right. So if you could communicate with any animal, what animal would it be and why?
It would be birds, because birds have the ability to fly all around and give whatever. So it's the Pied Piper. If I want to communicate, I can reach so many people and places with birds.
Gotcha. That is an amazing. I'll tell you what. Whenever I ask these questions, the answers that I get always blow me away. I feel like I try to confuse people with these questions, but it's like the answers are always better than the questions. So next one. All right. Would you? This is interesting. Would you rather have $1 million today, like somebody just come
Mhm,
and just give you a check for $1 million today, or
mhm.
would you rather get $2,000 every single day, but you have to spend it in its entirety and you can't save it from the day before. So you can't put it in any investments. You can't, you can't do something for later. It's a every day you wake up, here's your $2,000, use it up, and if you don't use it all up, then as I will, you can't accumulate it. So which one would you rather do?
Okay. And that's 2,000 for what time period?
That is 2,000 for the rest of your life.
Oh, so I take the 2,000.
Okay, so every day, $2,000. But you
Every day.
can't.
But I can,
Go ahead. You can't do what?
but I can still make other money with other things. I mean, if that's my only option, I would take the $1 million. If that was my only option, I'd take the $1 million.
Yeah, only
$1
option.
million.
No job. No, nothing
Okay.
else.
Oh, okay.
Yeah.
Then $1 million for sure.
Gotcha.
I'd take the $1 million because I could put that money to work.
There you go. There you go.
And with the power of compound interest.
There you go. Awesome. Awesome. All right. And the last one, if you could walk up, so two choices: walking on water, right? Just like the way you walk on water is the way you walk on the ground, or you can change the weather, and I'm talking like temperature, raining, snow, whatever, within a 1 mile radius of where you are at any moment. Which one would you choose?
Oh, I'd be a weather changer. Call me Storm for
you
sure.
Awesome. I love it. All right, awesome. So now at this point, this is where we talk about the first step section. So what is the first step that you would recommend someone who wants to learn more about using life insurance policies as a investment vehicle? What would you say is their first step on coming into a situation like that?
Sure. Their first step is to read that book, become self-educated. Okay. Number 2 is to hopefully schedule a meeting with me so I can show you certain scenarios that you can do with your time, with your money over the course of a period of time. Mm-hmm. You know, I have a lot of clients that come to me and don't know that banks give interest. Don't know when I say early retirement, they're like, no, the government says it's age 59. It says, no, retirement is a state of wealth. It's a state of, it's different, but they don't understand that. Right. But that's just a lack of education. Mm-hmm. So I would definitely educate people.
Gotcha. Awesome. And last section here, words of wisdom. So what are some words of wisdom that, for the people that are usually listening to this, what would you say to them just to kind of give them that hope and encouragement of this is possible or whatever it is, just some words of wisdom that you'll give for them?
So the best thing anybody can do is to invest in themselves. We are our most important asset, and we spend money and time investing in other things or listening to other people and investing in the things that they said. We're a culture where we set things and we forget about them. We shouldn't be that. We should be a culture that we take control of the things that we want to have and want to give. And I have a 3-point model. I want to have more, do more, and be able to give more. And I believe that everyone should look at things like that, but that has to start with yourself. We got to get out of this thing of believing in other people, listening to other people, but being too lazy to do it on our own. We have to take back the control and put things into play.
Gotcha. I love it. Awesome. Dimitri, thank you so much for coming on to this episode, man. This was amazing. I learned a lot, and we have a consultation with you tonight, my wife and I. So definitely excited to do that. And man, I look forward to working with you and learning and growing, man. So if you could stay on for a little bit, but thank y'all so much, and we'll see all you guys on the next episode.
Thank you.
Thank you for listening to the Your First Steps podcast. Let us know what you thought about this episode by leaving a review. And don't forget to subscribe.